Americans could see interest rates reduced by the end of this year, but what does that mean for the average household? From credit cards and mortgages to car loans, even your job, it all connects back to the Fed. And today we're breaking it down Federal Reserve 101 style, no confusing jargon, just real world information you can use with James Taylor Davis, a fiduciary advisor with Meridian Wealth Management. Good morning to you.
Good morning. Thank you for having me.
So glad to have you, especially so you can break down and make it a bit more digestible for us this morning. Let's start with some of the basics. What exactly is the Federal Reserve and why should it matter to everyday people?
The Federal Reserve is America's central bank. And a lot of people think that it's a federal agency. It's not. It's its own bank. It has nothing to do with the federal government. It's not a federal agency, but effectively, it's like America's banking thermostat. It's like the thermostat that's in the living room. If you change the temperature in the living room, it affects every room in the house. It goes out to all the banks across the country, and then it affects mortgages and car loans and all the rest. And personally, I think it affects us far more than the things that we, get distracted by and social media or what's going on with celebrity gossip. I think people should be far more in tune with what's going on with the Federal Reserve because that has a much more direct, substantive effect on their lives. And so I encourage people to spend more time informing themselves and becoming more educated on what's going on at the Federal Reserve than, some of the more frivolous things that we care about in everyday life.
You are talking to a lifestyle host, so I am going to say, celebrity gossip and making sure that we're aware of the Fed. They're on the same level for me, but making sure that we have the knowledge and we are aware of what's going on around us, especially when it's affecting our everyday lives. Now, we keep hearing about the Fed's proposal to cut interest rates after we saw the rates rise over the past few years. So what does all of that mean and why do you think they do it?
Well, they do it to kind of have a better control of cash that goes in the system. Think of it this way. If there's too much cash in the system, it's causing inflation, too much spending, they raise the rate and make it more expensive to borrow money to then go and spend. On the other hand, if things are not so hot, if things are a little cool, people aren't spending money, they can reduce the rate to incentivize borrowing and spending in the economy so that it gets things moving again. So I think we're at a really interesting time right now where we get some conflicting data. We do see that inflation is lower now, but I just got a Wall Street Journal notification this morning that private payrolls actually saw a drop. So we're seeing a lot of conflicting information, a lot of fast information. And so, the Fed has some tough decisions to make in order to do it. I hope that they do a responsible rate cut.
I think we can all agree on that. Can I ask you, because obviously people are moving through their everyday lives. They, like you said, are most likely not aware of some of the things that are going on around them. So what services and products do we use daily that actually impact that rate?
It's more of a question of what doesn't it affect. Look at the housing market, look at the auto market, look at the investment world. The Fed rate affects everything. It's like a ripple effect. You drop that stone in the lake and you just see that ripple effect go out. It's going to affect everything that we see from, housing. I'm really focused on how it's going to affect housing because here in Kentucky or there in Texas or all across the country, we see, a lot of sellers just sitting on houses that they can't sell because the rates are pricing out a lot of their buyers. If we could get a responsible rate cut, you would see a lot more people not being priced out of those homes based on, the mortgage limits for what they can spend monthly on a house.
And that's a big conversation because of the simple fact that a lot of us, especially people in my age bracket, for example, are looking to buy homes. And it's just really difficult to figure out what is the right timing, what's the right space to do that. I also want to get specific with an example so we can really break it down for people at home. What if we see like a 1% rate drop? How much would that save someone on an existing car loan for a car that's priced like $30,000? Would we actually see any difference?
You'd see a small difference. I think if it's a $30,000 car loan and it's 60 months, it'd probably go from $594 to $580, so about $14 a month or about $800 something dollars, over the life of the loan.
Yeah.
But I always think that it just really comes back to planning. Like I wouldn't be banking on the Fed to save you a much better car payment rate. That really goes back into like having more disciplined savings for a better down payment to control that at a better level. I always tell folks, if your credit score is in tatters, the Fed decision won't matter. you got to get really good financial discipline with yourself if you want to have a better benefit in terms of that car rate.
Yes, indeed. All right. So making sure that we have everything in our house together when it comes to
That's
our
right.
credit, our banking information, all of that before we worry about the Fed, but making sure that we also have the information we need. Thank you so much for giving us the knowledge that we need this morning so that we can apply it to our lives, especially when everyone is being affected. Appreciate you.
Thank you very much.